macro currency signals.
Why silver, gold, and commodities aren't done. Ladies and gentlemen, we're living through a moment where narratives are cracking. People are asking, is Bitcoin broken? Is silver about to explode? Are gold and commodities finished or just getting started? Here are key truths you need to understand. When people say something is broken, what they usually mean is that it has stopped rewarding them. It has stopped going up on schedule. It has stopped validating the story they told themselves. But markets don't break the way machines break. They don't shatter and stop working. They rotate. Capital is never static. It flows. It adapts. It searches for yield, safety, momentum, leverage, narrative. And when one asset class exhausts its upside energy, that capital doesn't disappear. It migrates. We've seen this pattern over and over again. Tech booms give way to energy runs. Financial assets dominate for a decade, then commodities awaken. Growth outperforms value, then value claws back leadership. What feels like collapse in one corner of the market is often ignition somewhere else. The emotional mistake investors make is assuming that if their preferred asset stalls, the entire system must be failing. In reality, the system is simply reallocating oxygen. Before we go any further, if this breakdown is resonating, make sure you're subscribed and notifications are on. Staying early matters in moments like this. Drop a comment below and tell me where you're tuning in from and what time it is on your side of the world. This conversation is global, and it's always powerful to see how wide the reach really is. Now back to the topic. When liquidity is abundant and optimism is high, capital chases innovation, disruption, exponential narratives. That's when speculative assets thrive. But when liquidity tightens, volatility rises, or confidence wobbles, capital becomes more selective. It asks different questions. It seeks durability. It seeks tangibility. It seeks assets that cannot be printed, diluted, or restructured by policy decisions. That's where hard assets begin to regain attention. Rotation is not random. It is structural. Large pools of money, pensions, institutions, sovereign funds cannot sit still. They rebalance based on risk, valuation, and macro pressure. If equities become historically stretched relative to commodities, eventually the imbalance corrects. If digital assets surge far ahead of physical assets, spreads widen beyond historical norms, and mean reversion becomes inevitable. The shift doesn't require panic. It only requires asymmetry. What makes rotation powerful is that it often happens quietly. There is no dramatic headline announcing the transfer of trillions of dollars from one asset class to another. Instead, you see subtle signals. Ratios begin to turn. Underperformers stop falling. Outperformers struggle to extend gains. Momentum divergences form beneath the surface. It feels boring at first, then it feels confusing, and only later does it feel obvious. Calling something broken is often a sign of recency bias. When an asset has delivered extraordinary returns for years, investors internalize that performance as normal. A slowdown feels catastrophic because expectations were extreme, but markets move in cycles of expansion and digestion. No asset class dominates forever. Leadership rotates because valuation extremes eventually correct. Sentiment extremes eventually mean revert. And capital constantly hunts for the next pocket of inefficiency. This is why understanding rotation is more important than predicting headlines. If capital begins flowing from speculative assets into commodities, that shift can persist far longer than most expect. It doesn't need a crisis. It only needs imbalance. And today, the imbalance between financial assets and tangible assets is historically significant. When paper assets trade at multiples detached from real-world constraints and commodities trade near production costs after years of underinvestment, the seeds of rotation are already planted. Markets are ecosystems. Energy moves through them. Pressure builds, releases, and rebuilds elsewhere. What looks like breakdown is often redistribution. What feels like the end of one narrative is frequently the birth of another. The key is not to become emotionally attached to a single asset class. The key is to recognize when leadership is shifting. Because when markets rotate, they don't send invitations. They move first. And by the time the crowd realizes that nothing was broken, that capital simply changed direction, the repricing is already well underway. If you want to understand where markets are going next, stop staring at price alone. Price is loud. Price is emotional. Price is what gets the headlines. But ratios are quiet. Ratios are analytical. Ratios measure relationships. And relationships change before narratives do. A ratio strips away the noise and asks a simple question. What is outperforming? What? Not in isolation. Not in absolute terms, but in relative strength. Because markets are not just about whether something goes up or down. They are about where capital prefers to be at any given moment. And that preference shows up first in spreads. Take the gold to silver ratio. When it stretches to extremes, it tells you something about fear versus speculation, about defensive positioning versus growth within the metals complex. When that ratio begins to compress after a long expansion, it signals a shift in appetite. It suggests that capital is moving from safety toward leverage within the same asset class. That shift often happens before silver makes its explosive move. By the time silver is on magazine covers, the ratio already turned months earlier. Or consider commodities relative to equities. When stocks outperform for years, the commodity to equity ratio collapses. Hard assets look dead. Capital ignores them. But eventually, those ratios reach levels that historically have not been sustainable. When the spread becomes too wide, gravity takes over. The turn does not begin with fireworks, it begins with subtle outperformance. Commodities stop falling as much as equities during corrections, then they start rising faster during rebounds. The ratio bends upward quietly. Most investors miss it because they are still focused on index levels. Spreads also reveal stress long before price breakdowns do. When mining equities begin diverging positively from the metals they produce, it suggests forward-looking capital positioning. Equity investors are anticipating higher margins before the metal price confirms it. Conversely, when miners lag badly, despite strong metal prices, that divergence can warn of exhaustion. The relationship leads, the headline follows. This is why professionals watch relative strength lines as closely as they watch candles. A breakout in a ratio can be more powerful than a breakout in price, because a ratio breakout signals a structural change in capital allocation. It means money is not just entering an asset. It is favoring that asset over alternatives. That distinction matters. Absolute gains can be driven by liquidity. Relative gains are driven by conviction. Ratios also help remove emotional bias. If silver rallies 10%, it feels exciting. But if gold rallies 12% in the same period, silver is actually underperforming. Without the ratio, the story looks bullish. With the ratio, the picture becomes nuanced. Markets often disguise weakness inside strength and strength inside weakness. Relative performance exposes the truth. Every major turning point in commodities was preceded by ratio shifts. Before inflation became the dominant conversation, commodities had already begun outperforming bonds. Before silver went vertical in past cycles, it had already started beating gold in relative terms. Before equity bear markets accelerated, defensive sectors quietly began outperforming growth. The signal was there. It just wasn't loud. Think of ratios as pressure gauges. When they reach extremes, they measure imbalance. When they reverse, they measure regime change. And regime change rarely announces itself with a speech. It shows up as math. A line on a chart bending upward after years of decline, a spread tightening when everyone expects it to widen, a quiet rotation that only those watching relationships can see. If you wait for price to scream, you are late. If you watch ratios, you hear the whisper. And in markets, the whisper is usually where the real money is made. Momentum is often misunderstood. People think it's chaos. They think it's emotion. They think it's random buying and selling driven by headlines and hype. But real momentum, sustained structural momentum, is one of the most elegant forces in financial markets. It is pressure building in one direction because the underlying conditions demand release. Momentum begins long before the public recognizes it. It starts with subtle accumulation. Volatility compresses, downside moves become shallower, sellers grow exhausted. The asset stops reacting negatively to bad news. That's the first tell. When something refuses to fall despite reasons to fall, strength is forming beneath the surface. Then comes the breakout. Not always explosive at first. Sometimes it's just a clean move above a multi-year range. But what matters is what happens next. In true momentum cycles, pullbacks don't fully retrace. They become stepping stones. Each dip finds buyers sooner than the last. Each rally extends slightly further. The structure begins to tilt upward in a way that feels almost mechanical. That's elegance. It's not frantic, it's not dramatic, it's persistent. In commodity markets especially, momentum reflects something deeper than speculation. It reflects supply constraints, capital underinvestment, rising input costs, geopolitical pressure, currency debasement. These forces don't resolve overnight, they build. And when price finally begins to reflect them, the move can sustain far longer than logic alone would suggest. People often underestimate how long momentum can persist once it locks in. They try to call tops early. They assume that because an asset has risen sharply, it must revert immediately. But momentum does not reverse simply because it has traveled far. It reverses when the underlying pressure changes. Until then, strength compounds. In the context of silver and gold, momentum is not just about price appreciation. It's about relative acceleration. When silver begins outperforming gold after a long dormancy, that's internal momentum within the metals complex. When commodities broadly start outperforming equities, that's cross-asset momentum. These layers stack. And when multiple layers align, the move becomes self-reinforcing. There's also a psychological component. Momentum attracts capital. As price trends upward, performance chasing begins. Funds rebalance. Algorithms detect trend strength. Retail investors re-enter after long absence. Each wave of capital reinforces the move. What started as structural accumulation becomes visible acceleration. What felt like a niche trade becomes mainstream positioning. But here's where the nuance matters. True momentum is disciplined. It respects higher lows. It absorbs volatility without collapsing structure. Violent corrections can happen inside strong trends. In fact, they often do. But as long as those corrections hold above prior structural levels, the trend remains intact. The elegance is in the rhythm: expansion, consolidation, continuation. This is why calling for extreme price targets should never be about fantasy. It should be about structure. If an asset enters a multi-year breakout after a decade of compression, if supply remains constrained, if monetary conditions favor hard assets, then the path of least resistance can extend far beyond conventional expectations. Not because of hype, but because of sustained imbalance. Momentum is the market's way of expressing that imbalance. It is the visible outcome of invisible pressure. When you learn to recognize it, not as noise, but as structure unfolding, you stop reacting emotionally to every spike and dip. You start reading the rhythm, and once that rhythm takes hold, once capital aligns with structural pressure, momentum becomes less about prediction and more about participation. The question stops being, how high can this go? And becomes, has the underlying force actually changed? Because until it does, momentum doesn't fade quietly, it carries. There's a dangerous illusion in markets that fundamentals drive price in real time, that earnings reports, supply data, inflation numbers, and policy decisions immediately dictate where assets trade. But if you study history closely, you see something different. Price moves first, structure shifts first, fundamentals are interpreted later to justify what has already happened. Markets are forward-looking mechanisms. They do not wait for confirmation. They anticipate. When capital begins positioning for a change in monetary conditions, for tightening supply, for geopolitical stress, it does not send a memo. It reallocates quietly. That reallocation shows up in price structure long before headlines catch up. Think about every major commodity bull market in modern history. At the beginning, the data rarely looked compelling. Inventories were comfortable. Analysts projected moderate growth. Commentators dismissed early price strength as temporary. Yet price kept climbing. Why? Because structure had shifted. Underinvestment from prior years had constrained supply. Currency dynamics were evolving. Capital was moving ahead of the narrative. By the time mainstream commentary turns bullish, the early stage of the move is often complete. Fundamentals then appear supportive because price has already adjusted enough to make the data look tight. Rising prices create the very scarcity headlines describe. It feels causal, but in reality, structure led the way. This is especially true in precious metals. Gold and silver often begin advancing during periods of subtle monetary instability. Not hyperinflation, not obvious crisis, just small cracks. Persistent deficits, expanding balance sheets, rising debt servicing costs, weakening currency purchasing power. These pressures accumulate beneath the surface. Price begins trending higher in response to long-term imbalance, not daily news. Investors who wait for perfect fundamental clarity rarely capture the heart of the move. They want confirmation. They want consensus. They want the data to align neatly with the thesis. But markets rarely offer that luxury at turning points. Instead, they offer structural clues: higher highs after long stagnation, shallow retracements, expanding relative strength versus financial assets. Price is not random. It is the aggregation of millions of forward-looking decisions. When a new trend establishes itself, especially after years of compression, it signals that capital has reached a new collective conclusion about risk and reward. That conclusion forms before economists revise forecasts, before institutions publish bullish reports, before the story becomes comfortable. The same dynamic works in reverse. Fundamentals can look strong at market peaks. Growth projections remain optimistic. Earnings appear solid. Commodity supply seems adequate. Yet price begins faltering. Distribution replaces accumulation. Lower highs form quietly. By the time the fundamental narrative shifts negative, the structural breakdown has already progressed. Understanding this sequence is critical. It prevents you from anchoring to lagging information. It trains you to respect the chart not as a speculative toy, but as a real-time summary of evolving expectations. When gold breaks out of a decade-long range, that move carries more informational weight than a single inflation report. When silver reclaims levels unseen in years and holds them despite volatility, that structure tells you something about positioning that quarterly data cannot. This doesn't mean fundamentals are irrelevant. They matter deeply over long horizons, but they tend to validate trends rather than initiate them. The market discounts future conditions ahead of statistical proof. By the time supply deficits are undeniable, price has often already repriced. So the discipline is this: watch structure. Observe whether breakouts hold. Notice whether corrections fail to break prior lows. Track whether relative strength continues improving. Let price behavior guide your interpretation of fundamentals, not the other way around. Because in every sustained commodity cycle, the pattern is the same. Structure shifts quietly, price trends persistently, fundamentals eventually catch up. And those who waited for perfect clarity realize that clarity arrived only after opportunity had already moved on. This is where conviction gets tested, not at the bottom, not at the breakout, but in the middle, when price spikes aggressively, headlines explode, and emotion runs hot. The question becomes unavoidable. Do you sell the spike, or do you stay the course? Silver is notorious for volatility. It doesn't move politely. It surges. It retraces sharply. It shakes out weak hands with speed and precision. That volatility is not a flaw. It's a feature of a smaller, thinner market layered on top of deep macro forces. When capital flows into silver, it can feel like a tidal wave, and when it pulls back, it can feel like collapse. The discipline lies in separating noise from structural damage. In powerful commodity cycles, spikes are common. They reflect momentum acceleration, short covering, speculative inflows, and sometimes genuine supply stress. But a spike alone does not invalidate a trend. What matters is what happens after the spike. Does price collapse below prior structural support, or does it consolidate above former resistance, building a higher base? That distinction is everything. Selling every spike may feel prudent, but it often leads to chronic underexposure in strong trends. You exit strength, wait for a deep retracement that never comes, and watch price stair-step higher without you. On the other hand, blindly holding without recognizing structural deterioration can erase hard-won gains. The balance requires a framework, not emotion. Structure provides that framework. In a sustained uptrend, higher lows define health. Corrections should respect prior breakout zones. Momentum should reset without fully unwinding. If silver rallies aggressively and then pulls back 30%, but holds well above its previous multi-year ceiling, that is digestion, not destruction. Volatility within strength feels uncomfortable, but it is often necessary to sustain the larger move. Time also plays a role. Every cycle has phases: accumulation, markup, public participation, and eventually distribution. Early in a cycle, volatility is sharp, but participation is limited. Mid-cycle, momentum broadens. Late cycle, euphoria dominates and corrections become shallower until they suddenly aren't. Understanding where you are in that sequence shapes your decision-making. Another critical factor is relative performance. If silver spikes but continues outperforming gold and other commodities on pullbacks, that internal strength suggests capital is still rotating toward higher beta within the metals complex. If mining equities remain firm relative to the metal itself, that forward-looking confidence reinforces the structural case. But if divergences begin forming, if silver makes new highs while miners lag badly, that can signal exhaustion forming beneath the surface. The line in the sand is not a price target. It is structural invalidation, a decisive breakdown below prior higher lows, a failed breakout that cannot reclaim lost ground, a sustained reversal in relative strength versus other commodities. Those are signals that the thesis requires reevaluation, not because volatility occurred, but because structure changed. Silver reaching extreme levels like $500 is not about fantasy. It is about magnitude within a monetary reset scenario. In environments where currency debasement accelerates and capital flees financial assets, precious metals can move in non-linear fashion. But those outcomes are conditional. They depend on macro forces aligning and remaining persistent. If those forces weaken, the path adjusts. So the real dilemma is not spike versus hold. It is discipline versus impulse. Are you reacting to emotion or are you responding to structure? Are you managing exposure strategically, trimming into parabolic acceleration while maintaining core positioning, or are you chasing strength and panicking on weakness? In strong commodity regimes, volatility is the admission fee. It tests conviction. It punishes excess leverage. It rewards patience anchored to structure. The goal is not to capture every dollar of upside or avoid every drawdown. The goal is to stay aligned with the dominant trend as long as the underlying architecture remains intact. Because when a true cycle unfolds, the biggest mistake is not enduring volatility. It's exiting a structural bull market too early simply because the ride felt intense. Commodity supercycles do not begin with celebration. They begin with neglect. They begin when capital has spent years crowding into financial assets, equities, growth narratives, leverage trades, while tangible assets sit dormant, underfunded, and overlooked. A supercycle is not just a rally, it is a prolonged period where real assets structurally outperform financial assets because the macro foundation shifts. To understand whether we are entering that kind of regime, you have to zoom out. For more than a decade, capital flowed aggressively into stocks and intangible growth. Multiples expanded, liquidity was abundant, global supply chains were optimized for efficiency, not resilience. Meanwhile, commodity exploration budgets were cut, mines aged. Energy infrastructure faced regulatory and political constraints. Investment in extraction lagged demand growth. That imbalance does not show up overnight, it builds quietly. When supply capacity stagnates while monetary expansion accelerates, when geopolitical tensions disrupt trade flows, when fiscal deficits expand and currency purchasing power erodes, the groundwork for a commodity supercycle is laid. A true supercycle requires more than inflation. It requires structural scarcity. It requires underinvestment meeting persistent demand. Industrial metals must be needed for infrastructure and technological transition. Energy inputs must remain constrained while consumption continues. Precious metals must reassert themselves as monetary hedges during periods of currency uncertainty. When multiple commodity categories begin strengthening together, that broad participation is a tell. Another hallmark of supercycles is relative performance. Commodities do not need to skyrocket immediately. They need to outperform equities consistently over time. When commodity indexes begin rising, while major stock benchmarks struggle to produce real inflation-adjusted gains, that divergence marks a regime shift. Investors anchored to equity dominance often dismiss early signs, but relative charts reveal the rotation clearly. There is also a macro feedback loop. Rising commodity prices influence inflation expectations. Higher inflation pressures central banks. Policy responses then impact currencies and real yields. Those changes feed back into precious metals and hard assets. In a supercycle environment, commodities become drivers of macro conditions, not just passengers. Skeptics argue that technological innovation and efficiency gains prevent sustained commodity booms. But history suggests otherwise. Every era believes it has solved scarcity until demand overwhelms capacity. The 1970s, the early 2000s, each cycle began with disbelief. Analysts cited productivity improvements and global integration as reasons commodities would remain subdued. Then structural demand collided with limited supply, and price adjusted violently. What makes this potential cycle different is the scale of monetary expansion and sovereign debt accumulation globally. When debt levels are extreme, policymakers have limited flexibility. Sustained high real interest rates become politically and economically difficult. That dynamic can support hard assets for longer than traditional models anticipate. But supercycles are not straight lines. They unfold in waves. Sharp rallies are followed by deep corrections. Sentiment swings from optimism to doubt repeatedly. The difference is that each correction holds above prior cycle lows. Each expansion phase pushes to new structural highs. Over years, the trend compounds. The key question is whether financial assets have reached saturation in relative valuation, while commodities remain historically cheap in comparison. If so, even a gradual rebalancing of global capital could produce powerful tailwinds for hard assets. Pension funds, institutions, and sovereign wealth funds shifting even small allocation percentages toward commodities would represent enormous flows relative to the size of those markets. So are we entering a true commodity supercycle? The early ingredients appear present: underinvestment, structural inflation pressure, geopolitical fragmentation, and extreme financial asset valuations. Confirmation will not come through a single breakout. It will come through sustained outperformance, multi-year higher lows, and broad participation across energy, industrial metals, and precious metals. Supercycles do not announce themselves at the beginning. They are recognized in hindsight. The opportunity lies in identifying the shift while it still feels uncertain, when commodities are strengthening quietly and the crowd remains anchored to yesterday's leaders. This isn't about choosing sides, Bitcoin versus silver, digital versus physical. It's about understanding structure. When liquidity shifts, when ratios turn, when momentum builds in neglected sectors, commodities don't die, they reprice. And if we are in the early innings of a structural rotation, then silver, gold, and real assets aren't done. They may just be getting started. Now the only question is, are you watching headlines or are you watching the signals?